So we have this question called William. It's a relatively recent question. The requirement, discuss with suitable computations. Once again, there are 2 professional marks available. Let's make sure. Now, there's professional marks available in practically every question you'll come across. So therefore, there could be 5 or 6 professional marks in total available in this exam. Let's make sure that we get hold of them. So we've got a number of transactions, the first of which makes it a little bit smaller. The first of which is in respect of a building. We sold it to a finance company for 5 million when it was worth 3.5, and then leased back. This is a sale and finance leaseback transaction. I can't remember what the next word is going to be. What do you think it just might be? Because. The lease term 20 years is equivalent to the asset life. William should therefore de-recognise the asset but defer the gain on disposal because it still has the risks of ownership. We're going to de-recognise it, and then we're going to re-recognise it as a financial asset. So what we're going to do first of all, so the reason why we're deferring the gain on disposal is because we've still got the risk of ownership. We're replacing one asset, a physical asset, with effectively a financial asset. We're going to debit cash 5 million, credit PPE somebody's not paid their fees, credit 3.5 million, credit deferred income, deferred revenue, whatever you want to call it, £1.5 million. The deferred income will be released over the lease term. So in the year ended the 31st of May X3, what are we going to do? Debit deferred income 1.5 million spread over 20 years. £75,000. Credit statement of profit and loss. 75,000. The lease is immediately recognized on the 1st of June X2 at the present value of the minimum lease payments So I'm going to debit a lease asset, 5 million, credit a lease liability, 5 million. The building is depreciated over the lease term, so that's going to be 5 million spread over 20 years. That works out as 250,000 per annum. The lease liability is calculated using the amortized cost method. So how much have we borrowed? 1st of the 6th X2, we've borrowed 5 million. The interest is 7%, so that's going to be 350,000. We've repaid 441,000. We carry forward 4909. I'm going to do that for one more year to work out the amount of the liability due in less than and more than 1 year. $4,909 plus 344 minus 441. So in our statement of profit and loss for the year ended the 31st of May X3, we charge interest of 350,000. In the statement of financial position, we show a lease liability of 4,909, of which 4,812 is due in more than 1 year, and 97,000 is due in less than 1 year. Or you could say non-current and current liabilities. So we had 7 marks worth of time to do that. Mentally at the back of my head I'm saying 7 marks is 12 minutes. I've done it within 12 minutes. So that's my target all the time. Break the answer down bit by bit, date by date, just picking up marks like little Lego blocks, one by one by one, adding them all together. Item B. Again, I'm making this as easy to mark as possible. Defined pension plan. If I had a ruler that would work on my computer, I would use it. Shortly before the year end, we decided to relocate a division from one country to another because of cheap labour costs. It's due to take place not until December. On the 13th of May X3, a detailed formal plan was approved, and the effective employees, we read further down, were informed on the 14th of May. This is before our year end. A provision is only recognised if a legal or constructive event, constructive obligation exists at the SFP date. By approving the scheme, and advising the employees, a constructive obligation arises at the 14th of May X3. We've done our calculations, so we've got a reason. So if you want to throw that in, throw that in. Half of the affected employees will be made redundant in July, and the remainder at some point later. The total relocation costs are estimated at 50 million. So we should recognise a provision and expense of $50 million at the 31st of May X3. This could be discounted because some of the costs are not due until December 20X3, but some of the costs are going to be incurred at a much shorter date. So I'm not going to do any calculations here. All I'm doing, I'm saying to the marker, hey, I know about discounting. Give us a mark. You've not given me the numbers to calculate it here, but there is a case to say 50 million is quite a big number. Even if you're discounting that at 5% for 6 months, 7 months, yeah, it could be a little bit of a sum of money. So it's worth considering. Probably not material, but who knows? if we take a look at the pension plan, because actually, whilst I set up the heading called pension plan, I've been talking about the provision. So you might want to go and change that, your heading. It says, as a result of making these changes, we've got a reduction in the net pension liability. So if there is a curtailment of the business, i.e. a major reduction, then any changes in the net pension asset stroke liability should be recognised at the earlier of the date the provision is recognised or the date of the curtailment. Now it says here the date of the curtailment is going to be July X3. When are we recognising the provision? We're recognising the provision. We've just done those calculations, haven't we? And we've recognised the calculations in May X3. Therefore, we should show in the financial statements for the year ending the 31st of May X3, what's happening here? We're going to debit our pension liability $15 million and credit statement of profit and loss $15 million. So again, that's another 7 marks, that's another 12 minutes. I'm within my time frame. I've got 7 points roughly, so I've certainly got at least 4. You know, we're looking to pick up 4 marks out of 7 each time. Move on to the next item. Share appreciation rights. These are cash settled share option schemes. We therefore recognise a liability at the SFP date based on the share price at that date. So let's just read about what's happening here. All of the rights vest after 2 years service, and they can be exercised during the following 2 years up to the 31st of May 20X4. The fair value at the right at the grant date was $20. Now, if it was an equity settled scheme, we would just be using that figure of $20. But this is a cash settled scheme. At the start of the year, the liability was, well, there's 500 share appreciation rights to 20 managers. There's no sign of any of those managers leaving. And at the start of the year, which is the 31st of May X2, the fair value of the shares, or the right, was $14. And because the scheme had started in X0, we'd already completed 2 years of our 2-year vesting period. That equals 119,000. During the year, managers exercised some rights Oh, sorry, no, that should have been, that's 17 managers, isn't it? Sorry, 3 managers left. The number's right. I can't follow my own notes here. During the year, some managers exercised some rights, and 7 managers exercised those rights, so it's going to be 500 shares by 7 managers, and at the time, the value of the right was $21. So that works out as $73.5 thousand as being our cost. That's going to be credit cash and debit our liability. At the 31st of May X3, there are therefore 10 managers left in the scheme and the liability is 500 times 10 at the year end, the 31st of May X3. The value of those rights is $24. So 500 times 10 times 24. That gives us a figure of 120,000. William wishes to know what the liability and expense will be. So let's work out our expense. We've got some debits and credits here. So let's work out our liability account. Our opening balance was 119. Our closing balance is 120. Our cash we paid out is 73.5. So therefore we've got a balancing figure of 74.5. Which is going to be our expense in our statement of profit or loss. Bit by bit, date by date, item by item. Very repetitive approach. I know it's dull, but it works. Next, item D. Acquisition of Chrissy, and it says William wishes to know how to account for this liability in Chrissy's financial statements and whether the treatment would be the same in the group accounts. As soon as you see the word "and," it means we've got two questions. We've got two questions, we've got two answers. We've broken the question down into our bite-sized chunks. So in terms of Chrissy's own accounts, it says the claimants are suing for damages of 10 million. William estimates the fair value of any contingent liability is 4 million and feels that it is more likely than not that no outflow of funds will occur. A provision is only recognised if there is a probable outflow of benefits. By probable, we mean more than 50%, don't we? William believes the outflow of benefits is not probable. Therefore, no provision is recognised but the nature and potential amount of the damages is disclosed. In Chrissy's notes to the accounts. So that's how we're going to do it with Chrissy's accounts, and we then move on to the consolidated accounts. Goodwill is calculated as the fair value of the consideration paid less the fair value of the net assets, liabilities, and contingent liabilities. Acquired. And I should, of course, thrown in the NCI at acquisition into there too. William should therefore include the damages as a contingent liability in the consolidated SFP. This will reduce the net assets of Chrissy by $4 million. So what's going to happen to goodwill? And therefore increase the goodwill in the group SFP by the same amount. And there's only 4 marks for this, and we split it into two elements. Yeah, I've written a fair amount there for 4 marks.